Hey, good morning, everyone. Welcome. It is Friday, September 1st. Surprisingly enough, it's my dad's birthday today, actually. So it's the end of the week right before we get a long weekend. So next week is going to be a shorter week in the markets. Monday's going to be closed due to Labor Day. And we got some interesting news that's coming out here today. So as I'm looking at this, what is going on right here? Uh, Sorry, one second. Anyways, so the U.S. Economy today, we expected fewer jobs to be added in August versus July, right? There was an expectation of 170,000 jobs added, and in the prior month, in July, we had the expectation of 187 jobs were added from that prior month, and the unemployment rate was expected to be at 3.5%. I'm just trying to, where are these numbers? The unemployment rate was expected at 3.5%. The core main headline figure was expected at 170,000, and the prior was 187,000. So realistically, we came out at 187,000, so the same as the prior month, which is a huge beat on the expectations. The market rose pretty well. The unemployment rate, however, popped up to 3.8% versus the 3.5% that was expected. So interesting kind of mix mash of different results from the headline figure there on the unemployment very specifically. And realistically, right, the labor force participant rate or percentage of the population that is either working or actively looking for work is also expected to be unchanged at 62.6%. I'm trying to find where the actual, okay, so the actual number came out at 62.8%. So a slight pop on that as well. There's also naturally the efforts to continuously push down inflation. That's been the Fed's main goal by increasing the interest rates. And the Fed has wanted to see more slack in the job market, indeed, and an overall imbalance between labor demand and supply is causing wages to remain elevated. But the batch of data that came out this week has pointed to just what the Fed wants to see: moderating labor demand. So we saw the ADP jobs report that came out on Wednesday, right? It showed companies in August added at least the least number of jobs in 5 months. We also had the JOLTS report, short for job openings and labor turnover survey, also revealed the number of job openings in July unexpectedly fell to the lowest level since 2001. So early 2001. Elsewhere, job cuts announced by employers more than tripled in August versus July. And one outlier this week was initial jobless claims, a leading indicator slipping below the consensus estimate. And also, the Fed's favor. The dual strikes in Hollywood are expected to impact today's jobs data as many companies support movie and television industry, which is probably pushing that unemployment rate a little higher than expected. So that was the main news that came out. A lot of people were looking for that. Yesterday, we had more of a sideways day, probably in anticipation of that realistically. And with that, what we saw was a decent pop in the market, right? We rallied into that mid 40, right? 45, 40 from that 15 low, huge order flow area that we were talking about yesterday. So we'll see. We're very close to the top of the distribution block on the S&P 500. We got that like 45.55 to 45.60. That's looming right above. And I think that we're very, very close. It's expected to be tagged before we see potential sell-offs come from that area. That's the top of the distribution block. And I don't anticipate buyers or sellers giving up the area too aggressively. Like they could potentially see a decent little flip to the short side. I'm going to be watching that area very carefully if I'm going to fade any of this. So U.S. personal spending in July also came in stronger than expected, while personal income rose less than expected. And according to the latest figures, that will be closely watched by the Federal Reserve. So household spending is the biggest driver of the economic growth and has already raised projections for the third quarter gross domestic product. Moreover, the headline and the core personal consumption expenditures PCE price index that came out yesterday, the central bank's preferred inflation gauge, right, held steady in July, a little pop actually on a month-over-month basis, and came in line with estimates. So that indicates that the central bank isn't necessarily considering cutting rates soon, and we'll see what we have in the September meeting that's coming in towards the end of the month. So what else do we have? We also have some stimulus measures continue to be rolled out in the real estate headwinds weighing in on China's economy. The government will now allow the country's largest cities to cut down down payment percentages for home buyers and will persuade lenders to lower rates on existing mortgages. However, the question remains whether these steps will be able to revive the property market and an economy that President Biden has referred to as a ticking time bomb over in China. So, other news. The stimulus actions unveiled by China include lowering bank reserve requirements, ratios for foreign currency deposits, as well as expanding tax breaks for child and parental care and education. So we saw, what was it, Evergrande that took a massive hit, right, in the U.S. especially, and really putting some downside pressure. But another positive note, right, China's efforts for stimulus boosting is that I think they're cutting the what was it, like the tax by like 50% on stock market activity, which put a lot of upside pressure in a lot of Chinese names that have seen some decent uh, bullishness over the past week. So in terms of today, we have some more news, right? Fed's Messrs talking about inflation drivers and dynamics at the 2023 conference at 9:45. We have ISM manufacturing index at 10, construction spending at 10, and then Baker Hughes at 1. Realistically, looking at this market right now, let me see where we're at actually. Looking at this market, we're still putting some upside pressure on this, right? They're still holding out the upside. We're coming into some key resistances not too far from where we're at right now, 45.60, 45.58. But what we've done, on the S&P 100 futures is we've popped through that 45.34, which is naturally putting some upside pressure in the overall market, right? That is a massive, massive order flow pivot where we saw a huge amount of orders traded yesterday. A lot of stuck traders actually hit it really hard. And now that we're above it, realistically, that area is becoming a pivot, natural order flow pivot that buyers would expect to actually hold out for the long side. So any dips into 45.34 on the S&P 100 futures, I'm expecting to see some kind of rally and some kind of buy pressure get placed into that area to see if that long can continue. Since we're now above it, we're also pressing prior day highs, and we're trying to continue that move to the upside. So that's what I got for Friday. Happy Friday, everyone. Join us. This is the last day for our live trading room that's going to be open to all before we go back in discreetness on Tuesday, I should say, because it's a long weekend. Everyone enjoy the long weekend, and we'll see you guys next week. So thank you and take care.